Are gaming companies still a good investment, and have they ever really been one? Sometimes people look at the gaming industry from the outside and assume it must be a gold mine. Games keep getting bigger, launches get louder. The entire world seems to be playing something every day. So, the doubt forms. If gaming is exploding, why do so many gaming stocks feel disappointing? This is where the confusion usually starts. Many viewers imagine that a fast-growing entertainment market automatically means fast-growing share prices. They think that if people love a product, the company behind it must be flourishing. Ubisoft releases a new hit, and the stock should fly. Nintendo announces a new console, and investors should rush in. The logic seems straightforward. Games equal demand. Demand equals profit. Profit equals investment opportunity. But when you look closely, the picture is very different. Gaming companies face a strange mix of high costs, unpredictable sales cycles, long development timelines, and constant risk. One successful game can lift revenue for a year, but a delay or a flop can wipe out the entire boost. This makes earnings inconsistent, and markets dislike inconsistency. That is why many gaming stocks move sideways for years, even when the games sell well. Investors are reacting to risk more than excitement. Take Ubisoft as an example. For years, the company has been behind huge franchises, but delays, restructuring, and rising budgets have made the business difficult to scale. EA is more stable thanks to sports titles that renew every year, but even they face pressure when a release underperforms. Nintendo has enormous brand power, but its revenue still depends heavily on hardware cycles, which rise and fall every few years. Sony mixes gaming with many other businesses, but that also means its gaming division alone rarely drives the stock. In other words, the games business is big, but not always predictable, and markets reward predictability. This is where the comparison with companies like Nvidia or AMD becomes interesting. They are not gaming studios, but their products power almost every platform and every player. They benefit from the growth of gaming without depending on one hit title. They grow through broader trends like AI, cloud computing, graphics demand, and even scientific computing. Their revenue streams are diversified, which means fewer sudden drops, fewer surprises, and a much cleaner long-term growth curve. So are gaming companies a good investment? The honest answer is that they can be, but they are rarely stable investments. They behave more like entertainment businesses than like long-term compounding technology stocks. Investors who follow the sector without understanding this mismatch often feel confused about why the industry expands, but the stocks do not mirror that expansion. What this understanding changes is simple. You stop imagining gaming stocks as a guaranteed ride upward and start seeing them as creative companies, with all the volatility that creativity brings. And once you see that, you can make clearer choices. You might still invest in a studio you believe in, but now you know why the risk is higher than it looks. Or you might prefer the hardware and chip makers that grow alongside gaming with far fewer bumps. If you found this breakdown useful, remember to subscribe. It helps this channel keep creating simple and honest explanations that make the financial world easier to understand. Thanks for watching. Simple Revenues, finance made simple.